You ever look at the cryptocurrency markets and just, feel completely lost? Prices shooting up one minute, crashing the next. It's this wild ride.
Oh, absolutely. There's this one research paper we looked at that called it a vast, ever-shifting ocean of digital assets. That kind of nails it, doesn't it?
It really does. That constant movement, the volatility,
Yeah.
it makes you wonder what's really driving it all.
And that's exactly what we're diving into today. We want to get past the surface level noise.
Yeah, forget the hype for a bit. We're looking at this really detailed study. It's called The Whale and The Minnows by Gadurley, Chen, and Hale.
Right. And they crunched a lot of data. They looked at everything from January 2014 all the way to May 2023.
Trying to figure out what makes the big ones, Bitcoin, Ethereum, XRP, swing so much.
Yeah, and they didn't just look at prices. They dug into news, social media, even what the biggest holders, the whales, were doing.
So think of this as like your shortcut. We've done the heavy lifting on this research to pull out the key stuff, the surprising bit.
Hopefully bring a bit of clarity to all that chaos.
Okay, so first things first. How did they even measure this volatility thing? It feels so, chaotic.
That's a great question. They needed a solid number, right? So they used something called a 30-day rolling standard deviation of log returns.
Whoa, okay. Bit of a mouthful. Break that down for us.
Yeah. Basically, think about tracking the daily percentage change in price. Up 2%, down 3%, that sort of thing. This method looks back over the last 30 days of those changes and figures out how much they've bounced around the average change.
So, like if the daily changes are all over the place, big ups, big downs, the number goes up.
Exactly. Bigger swings mean a higher number, meaning higher volatility. It just puts a number on those really turbulent periods.
Got it. So it's a way to quantify the roller coaster feeling.
Precisely. Gives us something concrete to actually analyze.
Okay. So once they had that measure, they started looking for causes, right? Focusing on what they called investor attention.
That's the core idea. They tracked attention in three main ways. First up was institutional attention.
Okay, institutions. How'd they track that?
They counted the daily number of crypto-related news stories on Bloomberg.
Ah, Bloomberg. That makes sense. That's where, the finance pros, the big institutions get their news.
Exactly. The thinking is, what shows up there reflects what the big money is paying attention to and potentially reacting to.
Right. If big banks or funds are reading about crypto on Bloomberg, their actions could definitely move the needle. What else?
Second was retail sentiment. For that, they looked at Twitter.
Twitter. So, just counting tweets.
Pretty much. They counted the daily tweets mentioning Bitcoin, Ethereum, and XRP. It's a way to gauge the buzz among, individual investors, the smaller guys.
Capturing that sort of grassroots feeling, what everyday people are saying online. Okay, makes sense. And the third type?
That was whale activity.
Whales. Sounds dramatic.
A big fish.
You got it. They track the number of crypto addresses holding a really significant chunk of each coin, like maybe 0.1% or even 0.01% of the total supply.
Wow. So these aren't your average holders. Definitely not. And the reason they matter is because if one of these whales decides to buy or sell a huge amount, that single action can potentially impact the whole market price.
Okay, so three angles. Institutional news via Bloomberg, retail buzz via Twitter, and these big whale movements.
Yeah.
So what did they find? What actually drives the volatility?
Well, this is where it gets really interesting, especially for Bitcoin and Ethereum.
Yes.
The study found that for BTC and ETH, institutional attention, that Bloomberg News count, was actually a much stronger predictor of volatility than the retail chatter on Twitter.
Wait, really? So what the financial news says matters more for Bitcoin and Ethereum price swings than, what's trending on crypto Twitter?
That's what the data showed. It's quite a significant finding, actually.
Huh. How did they confirm that?
They used some pretty sophisticated statistical models. One type was called GAR-CHX.
GAR-CHX.
Okay. Think of it like this. It doesn't just look at price changes. It looks at how much the prices are swinging. Is the turbulence itself increasing or decreasing? And then it sees if things like news coverage predict those changes in turbulence.
Okay. So it's looking at the volatility of volatility, in a way.
Kind of, yeah.
Yeah.
And they found a clear positive link. More Bloomberg stories tended to come before bigger price swings for Bitcoin and Ethereum. The coefficients were positive and significant, statistically speaking.
And they didn't just use that one model, did they? I think the paper mentioned machine learning, too.
They did. They threw some heavy-duty tools at it: Nartek networks, random forests, support vector regression. These are algorithms designed to find really complex patterns in data.
Okay, so advanced computer analysis.
And they basically confirmed the GRCH findings. Across these different machine learning approaches, institutional coverage kept popping up as a really important factor for forecasting BTC and ETH volatility.
How did they know it was important?
They use something called SHAP value analysis. It's a technique that sort of ranks how much each input, like news counts or tweet counts, contributes to the machine learning model's prediction. And institutional news was consistently ranked at or near the top for Bitcoin and Ethereum volatility forecasts.
Okay, let's unpack that a bit. So for the two biggest cryptos, if you're trying to get a sense of when things might get choppy, you're actually better off watching the financial news aimed at institutions, not just the crypto community buzz online.
That seems to be the major implication, yes. It suggests that the narratives forming in traditional finance circles are now a pretty powerful force in these specific crypto markets.
It points to them becoming maybe a bit more mature, or at least more intertwined with traditional finance.
That's certainly one interpretation. The flow of information within those established financial networks seems to really matter for price stability or lack thereof.
But it wasn't the same story for all three coins, was it? What about XRP?
Yeah, XRP was different. It showed a much more nuanced picture.
Oh,
Well, for XRP, that retail buzz on Twitter, it played a much smaller role in predicting volatility. Sometimes they even found a slight inverse relationship.
inverse. So more people tweeting about XRP might actually mean less volatility. That sounds backwards.
It does seem counterintuitive at first glance,
Right.
but the researchers had a theory.
Okay.
They suggested it might be linked to all the regulatory uncertainty that's often surrounded Ripple and XRP. Their idea was that maybe during times of bad legal news or regulatory pressure, retail investors get cautious. They might pull back from trading or even just talking about XRP as much.
Ah, okay. So the buzz dies down because of potential trouble, and maybe trading volume slows too, leading to less volatility even while there's significant news happening.
That's the hypothesis. It could explain why increased Twitter activity didn't correlate with higher volatility, and maybe even the opposite in some cases.
That's fascinating. It really shows you can't just apply the same logic to every cryptocurrency. They each have their own dynamics.
Exactly. What drives Bitcoin isn't necessarily what drives XRP. The market reacts differently.
Okay, what about the whales? Did the big holders shake things up like you'd expect?
Well, for Bitcoin and Ethereum, yes. The study found that whale activity changes in the number of addresses holding large amounts did have a noticeable impact on volatility.
So the idea that a few big players can make waves,
Mm-hmm.
that holds true for BTC and ETH.
It seems so, based on this research. Their large trades can definitely send ripples through the market and contribute to those price swings, like a big ship moving through the water.
Right, but different for XRP again.
Different for XRP again. The influence of whales seemed less pronounced there.
Why would that be?
The researchers pointed to a couple of things. Maybe XRP's ownership is a bit more distributed compared to the early days of Bitcoin, perhaps. And also, a very large portion of XRP is held in escrow by Ripple.
The escrow. So maybe that structure, plus how the coins are held, dampens the impact of individual large holders.
That's the suggestion. It could contribute to XRP having maybe a bit more stability from that specific factor, even with all the other legal stuff going on. It's another interesting contrast.
So the way ownership is structured matters too. It's not just attention, it's also about who holds the coins and how.
Absolutely. The underlying structure of the asset seems to play a definite role in how these forces play out.
The study also compared how well these different models could actually predict the volatility, right? Not just identify causes.
Yes, exactly. And this was another win for the advanced techniques. The machine learning models, the NARX, random forests, SVR, they consistently did a better job predicting volatility across all three cryptos compared to the more traditional GR-RCHX model.
So the fancy algorithms were better forecasters.
Generally, yes, which kind of tells you how complex these markets are. They have these nonlinear relationships, things that aren't just simple cause and effect, that the machine learning models are better at picking up.
Okay, so complexity rules.
Yeah?
But was there anything else on the prediction side?
There was actually an interesting little nuance. They found that even simpler models, ones that only looked at the attention measures, just the Bloomberg news counts and the Twitter counts, could sometimes perform almost as well as the really complex machine learning models.
Really? So just tracking attention was almost as good sometimes?
In certain scenarios, yeah. Which really hammers home how fundamentally important that flow of information and investor attention is.
Right.
Even if the market is complex, just knowing where people are looking gives you a lot of predictive power.
That makes sense. So, okay, let's boil this down. What does all this mean for you, the listener, trying to make sense of crypto?
Well, I think for investors, especially if you're involved with Bitcoin or Ethereum, the big takeaway is maybe pay a bit more attention to institutional news sources, like Bloomberg.
Right. That might be a better early warning sign for volatility than just watching Twitter trends.
This research suggests it could be, yeah. It points towards those more traditional financial information channels having a real impact on volatility for the majors.
So maybe dial back the Twitter doom scrolling and skim the financial headlines instead.
Could be a strategy worth considering based on these findings for BTC and ETH volatility. And then for regulators, the study kind of nudges towards thinking about transparency.
Transparency around the whales.
Yeah, around large crypto holdings and how they're managed. The idea is that if there was more visibility into what the big players are doing, especially in Bitcoin and Ethereum, it might help understand and maybe even mitigate some of those really sharp, destabilizing price moves.
Interesting. So greater clarity on whale movements could potentially lead to calmer waters.
It's a potential implication suggested by the research, something maybe worth looking into further. And for you listening in, hopefully this deep dive gives you some, data-backed insight, something more solid than just gut feelings about why prices are moving.
Absolutely. Moving beyond just reacting to the craziness. So just to recap the big points from the Whale and the Minnows, institutional news seems key for Bitcoin and Ethereum volatility.
Right. Retail sentiment is more complex, varies by coin, maybe even inverse for XRP sometimes.
Whales matter for BTC and ETH volatility, less so, it seems, for XRP, potentially due to structure.
And while fancy machine learning models are great predictors, just tracking attention itself is surprisingly powerful.
Understanding these drivers, it helps you navigate, right? Get a clearer picture of what's going on beneath the surface.
That's the goal, to move beyond just watching the price ticker and understand the forces at play.
Okay, so here's a final thought to leave you with, building on all this. As we see more and more institutional money and attention coming into crypto, how might that fundamentally change things long term?
That's the big question, isn't it? If institutional news and behavior become even more dominant drivers, will crypto volatility start to look more like traditional market volatility? Or will it stay its own unique beast?
Will that balance of power between, say, the whales, the institutions, and the retail crowd keep shifting? And what does that mean for future price swings? Definitely something to keep an eye on.